Welcome everyone to BDO's webinar designed for professional services firms. My name is Louis Keeping and I'm a tax director focused on advising professional service firms with 18 years experience. I've helped put together the webinar series for the past 10 years and it's proved quite popular amongst PS firms, providing good updates every couple of months. So for today's webinar, we're focusing on the latest VAT issues affecting professional service firms, and this will include guidelines for good compliance and outcomes from HMRC's thematic review, which I know is on a lot of firms' minds, and we're speaking to lots of clients about. Bad debt relief and associated VAT issues, digital age developments, as well as a case law update. So for those of you who don't already know, BDO is the world's fifth largest accounting network, providing auditing, advisory, and taxation services in over 160 countries. We've been long-standing advisors to the sector, and our national professional services team is one of the largest dedicated sector teams within a UK accounting firm. Through our strong sector focus, we work with a range of clients from boutique firms through to large international businesses, which will include partnerships, privately owned corporates, listed, and private equity-backed business. So our speaker today is Ishvinder Bedi. Our professional services team work with Ish on a number of our clients, and I'm sure a number of you already know him quite well. But Ish is a director in the VAT team with a focus on the professional services sector. So, bit of admin. As always, we're running this webinar live, and we encourage you to ask questions using the Q&A feature, which is at the top of your screen. We'll pick up as many of these questions as we can at the end of the webinar or during the webinar. If time does not permit, we'll come back to you after the session. We will finish within the hour and we'll share the slides with you and the link to the recording in the coming days. So over to you, Ish.
Thank you very much, Louis. On to the next slide, please. So the first thing that we want to bring up today was HMRC's guidelines for compliance. Now, a lot of you may have seen HMRC release these guidelines for compliance in a number of different areas. So, for example, football agency fees, transfer pricing, and so on. Guidelines for Compliance 8 are HMRC-specific guidelines in regards to VAT accounting and record keeping, and really focuses on your controls and processes that you have in place, and effectively what HMRC would expect in various areas of the business, what the different control points are that you need to think about. So they're really designed to help businesses plan, carry out, and review their accounting and compliance processes to really ensure that VAT is accurately declared. And they cover a range of different areas, which we will get into shortly. Now, interestingly, HMRC have said that this is a guide for all businesses and not just large businesses. So there needs to be obviously some thought, regardless of your size or complexity, as to these guidelines and effectively what you're currently doing. So the key point here is doing some sort of cross-reference against your current VAT practices, your current controls and processes, and thinking about what HMRC's expectations are. And then seeing where you really kind of stack up in regards to that sort of benchmarking and where you might need some potential improvement. Next slide, please. So what do the guidelines for compliance really cover? Well, to begin, they go over your general approach and really sets out good practices in various areas around the controls and your identification of risk and the mitigation of risk. So to begin with, they bring up risk management. So how do you identify, evaluate, and prioritize your risks? What do you do in terms of having controls to reduce those risks? And what triggers do you really have to try to reassess those risks and how relevant they are to your business? They look at control design. So thinking about the various controls that you've introduced and the nature, the frequency, and coverage of a control. Now, interestingly, they mention things like how a simple and automated control is much preferred to, say, a complex and manual check. They also talk about how proactive controls are preferred over reactive controls. And what was actually quite surprising was talking about how automated 100% checking is more preferred over sampling, which I think is, in an ideal situation, would be the gold standard. But in most cases, in every client that I've been dealing with, 100% checks aren't really possible. They have been focused on sample checking of invoices for high risk transactions. So obviously, I find it quite interesting that HMRC have flagged this point in their own guidelines for compliance. In terms of documentation, this is obviously a common area that can sometimes be lacking, where you may have controls and processes in place. They may be appropriate, but then they're not necessarily as formally documented as you may have liked. So again, to picking up on documentation, it's how clearly defined are they, and in terms of their scope and reach. Where are the actual controls sat and who has responsibility for those? So for example, are those held in-house? Is it with a shared service center overseas? Could they be outsourced? Do you have a documented flow of the transactions with the controls that you have in place in various stages of that whole process? And is your documentation up to date? Now, a lot of those points may come up if you, for example, you are dealing with SAO or otherwise. But again, it's a good a good summary of the key things you need to be thinking about.
And it's just quickly on that. I guess there's obviously quite a lot to think about and a lot to manage. Are you seeing, you may well come onto this shortly, are you seeing more of a technology solution focused approach to being able to manage your VAT processes? Because it seems there's a lot you need to be in control of.
Yeah, we are, and if you think about how before, you'd get HMRC's view on technical matters. Now we're getting HMRC's view on how you're actually meant to be managing your compliance and how what good tax practice looks like. They are clearly focusing more on automated checks and data rather than the old school manual reviewing of individual invoices and trying to do manual detection over kind of proactive controls. It has to lean more towards technology to do some of those checks for you, because otherwise it's just an impossible task.
Yeah, great.
And then finally, picking up on assessing of controls. So again, it's a piece around how do you make sure the controls that you've implemented continue to be appropriate and adequate for your business, and that they continue to be designed effectively for your business. Next slide, please. So then what else do they pick up on? So as I mentioned, these guidelines for compliance are wide ranging and pick up on various areas of the business that really could have an impact on your VAT. It's not just your VAT return and your VAT return reporting. So to pick up on the first point that they look at, it's order to cash. So effectively your sales process. So they've listed out various control points that they would expect in various parts of that whole order to cash process. So in your sales order, what checks do you have to basically maintain confirm the VAT treatment there? On supply delivery, how do you know, how can you ensure that actually you've actually provided your supply, if it's goods or services, that the relevant VAT treatment's being applied? That on your invoicing, so your tax points, how do you make sure that you're invoicing correctly? How do you make sure it's a valid VAT invoice? How do you make sure that you contain the correct tax point, i.e. the time of supply on your invoice? On self-billed invoices, again, the point stands. So self-billing is often an area of challenge for HMRC as part of any sort of inspection. What agreements have you got in place? How often do you review them? Who is responsible for the invoice? When do you check to make sure that the VAT number quoted on a self-billed invoice is correct? And same with obviously credit notes and receipt of payment. There are various control points that they would expect in those various phases of the order to cash process. Likewise, with procure to pay, it's very similar. So looking at purchase orders, the receipt of a supply, whether that's goods or services, your invoicing, reverse charge, credit notes, etc., and self-billing. Quite often when it comes to your procure to pay, the key things that you're looking at are, do you have a valid VAT invoice? How do you code those? And those kind of steps to basically make sure that you can automate that process as well as you can, and then try to identify things that don't quite look right. Your staff expenses. So more often than not, you might be using your own staff expenses system, which has its own VAT coding. Well, then how does that then fit in with your actual ERP system? Because you could have a separate list of tax codes on your staff expenses system as you may have on your ERP system. So how does that data then flow through? What is your process in terms of the actual submission of an expense and the actual workflow and approval process? What sort of reviews and audits do you have of those expenses? And then on top of that, they pick up on common areas of risk. So, for example, business entertaining, where obviously you're not allowed to recover VAT on entertaining anyone other than your own staff, and motoring expenses. So what VAT can you reclaim? Do you have a valid fuel receipt, etc.? Then you have your record to report. So in terms of your system implementation, your GL operations, your VAT reporting parameters, what checks do you have in place to basically make sure that when you run your VAT report, that it includes all the data that you need to include. So a common issue could be, for example, a difference between the tax point, i.e. the time of supply, and a processing date. So i.e. when you actually include that invoice, either purchase or sales, on your system. And the two can sometimes not necessarily align, particularly if, for example, you have to do a manual journal entry to post a certain invoice. In regards to actual VAT reporting, so do you have organizational units for different subsidiaries or different VAT registered entities so that you're able to split transactions between the different entities that you need to report? Now, I know in some cases, in some systems, that's very difficult to operate, and actually they operate on a single organizational unit for a number of different subsidiaries, meaning that they can have access to a range of different tax codes around the world at the same time, and that in itself causes issues. Then what about GL posting and direct journal entries to process certain transactions? Do you have a requirement to include a tax code or a VAT determination as part of any journal entry? Making tax digital and your compliance in regards to that. So what checks do you have in regards to making sure that you are compliant with MTD? How do you ensure that the entire process is digitally linked and that you don't have any manual intervention in that process? Your return consolidation. So if, for example, you're in a VAT group, how do you, what are the processes you have in place to ensure that you consolidate that return in a way that's still MTD compliant, but also minimizes risk of lost transactions or lost tax? And then your checks that you may well already be applying. So your reconciliations, your risk-based checks. So again, what are you doing in regards to that? And it'd be worth taking a look at what HMRCs' expectations are in terms of their control points and what you're actually doing. And then finally, when it comes to actual submission, so what is the process for submission? How do you ensure that you submit on time, particularly given the changes around the penalty position? And then how do you ensure payment is also made on time? Then you get into things like manual adjustments. So as per Making Tax Digital, manual adjustments are allowed where in certain instances. So for example, your capital goods scheme, partial exemption, corrections for errors. So again, what processes do you have to ensure that you're including the various manual adjustments you need to include? How do you verify what those manual adjustments need to be? How do you make sure that they've then been entered into the VAT return correctly? And they also then pick up on things like outsourcing. So this isn't just a piece around the outsourcing of your VAT return, which you may have already done, but it looks a bit more widely to your general process with regards to outsourcing. So for example, are there some key business processes that you outsource? It might be your AP, it may be your AR function, but those can obviously have an impact on your VAT determination, whether it's on recovery or your liability for sales. So what sort of governance do you have in regards to that? Who has ultimate responsibility, and how do you get comfort that they're applying the right processes and the right VAT determination if it's been outsourced? And again, that kind of picks up on your general piece around ownership, who ultimately has responsibility for all of that. Next slide, please. So what are some of the key takeaways to think about? Well, these are really detailed guidelines, and they are really helpful. But it does really need some time to review and assess against the business, because there is a lot of detail in there, lots of different guidelines, and the chances are they could very well be updated in the future too. As I mentioned before, it's not just limited to large businesses. So all businesses of any size and complexity really do need to be taking a look at this. Now, that's not to say then one size fits all and that you have to tick every box that HMRC is putting down for you in these guidelines. Ultimately, they leave responsibility to the taxpayer to determine what they think is appropriate for their business based on their complexity and based on their size. So it's not a piece that you have to make sure you meet all the conditions, but you do need to have an assessment of the guidelines for compliance to then think what is appropriate for your business and what are the types of control points that aren't. And then more practically, there's some other things that you probably need to be thinking about. So in terms of the worst case scenario, you have to submit an error correction. And then there's a discussion around penalties. Could a lack of comparison against the guidelines for compliance for VAT process and controls lead to a higher risk of penalties? Because they could potentially argue you haven't taken reasonable care if you haven't really compared against the guidelines for compliance. And in those guidelines, there were potential checks and balances that HMRC would suggest could have mitigated the penalty or mitigated the error that had arisen. SAO considerations. So obviously every year, if you're in the SAO regime, you would have to sign off and certify that you have appropriate controls to manage relevant taxes for that year. If you haven't done a benchmarking exercise, then and if there are potential shortfalls in regards to your control and process framework for VAT, then is there a risk that around that certification process? Business risk ratings. So as I'm sure a number of you have dealt with, HMRC will, if you're a large firm, HMRC will often come attend a meeting with you to talk about your risk, to go through various areas of the business, and then give you a risk rating, which then can have an impact on how often you may receive inspections or queries from HMRC. Again, if there are potential shortfalls in your guidelines, in your controls and processes, this could be an area that HMRC look to query. We've seen, for example, in the past, HMRC raising a lot of questions around place of supply rules and your controls and processes around that. Given these recent guidelines for compliance, this could also be an area that HMRC want to get a bit more comfort on to make sure you have a well-controlled framework for VAT. One thing that's also been left a bit vague is what the expectations are for a minimum level of control. Again, they leave it to the taxpayer to really determine what they think is appropriate for their business. And I think that makes sense. But there's a lot of documentation about what HMRC thinks is good, but not what HMRC effectively thinks is absolutely essential. So again, there is probably an assessment here around what types of controls you need and what types of controls HMRC have suggested that are superfluous based on the nature of your business, and really having something to document why you haven't bridged that gap. And more recently, and I know a number of firms on the call have seen this as well. We've seen in the last few weeks increasing amount of VAT inspections. So HMRC have written to a number of different taxpayers, informing them of their intention to do an on-site inspection in the next 2 to 3 months. So they haven't necessarily confirmed what they're going to be looking at, but just that they intend to come out. Now, given the recent release of the guidelines for compliance, again, there's the potential chance that those could be raised as part of that general review. But again, I think it's really key in advance of any inspection to really do a benchmarking of the guidelines for compliance against your general VAT control framework, to then understand where potential risks may lie and what you may need to do to manage those. Next slide, please. So what are some key questions you could ask yourself? Well, is a business identifying and documenting risk regularly? And is it doing so with the guidelines that I suggested before? So what are you doing to identify, to mitigate risks? What are you doing to evaluate those risks compared to other risks? Are controls and procedures regularly being reviewed, and are they well documented? Are the controls sufficiently automated, or are they too reliant on manual detection? As I mentioned before, there seems to be a focus more on technology and automation rather than manual detection. Are all staff involved in the VAT return compliance process adequately and appropriately trained? And then actually going beyond that, anyone who has responsibility for any VAT determination, whether it's on sales or on purchases, and your ability to recover VAT, how appropriately trained are they? What sort of guidelines do they have to basically make sure they make the right decision? Are the interfaces between systems documented for VAT process purposes? So again, thinking about MTD, are you comfortable that you're compliant with MTD rules? Are there reviews of IT infrastructure carried out, particularly if there's changes in the business? Does the business have clear ownership and accountability when it comes to VAT controls and processes? Who is really responsible for determining this? Because again, as you've seen, these guidelines cover a range of different areas in which other people could potentially have responsibility. So who is then therefore responsible for determining VAT correctly on sales? Is it the finance team, or would it be the fee earners? And does the business have a clear process guide to help team members with any sort of VAT determination that they have to make themselves? Now, if the answer to that is you're not quite sure, or you have some concerns, obviously we're happy to have another discussion if that's something that could be of help. Next slide, please. So moving on, we also want to bring up the thematic review, which was obviously last year, in which HMRC raised a number of questions around the place of supply rules and also your determination of supplies where VAT hasn't been charged. Again, leading into the whole trend around controls and processes, that they really want to understand what controls and processes you have, whether there were any potential risks, and if there were any, and after a sample checking, whether there were any corrections that needed to go in. Now, we've started to see some responses in which HMRC have confirmed that around half the responses demonstrated that there were new safeguards being put in place. So again, looking at your controls and processes. And they highlighted a number of different areas that seem to be common errors, effectively. So incorrect data being input from the outset of the client engagement. So again, that is a critical piece, because obviously a lot of the VAT determination can be set when you set up a new client. Normally, a VAT code will be attributed to a client at that point. So what information are you using, and what verification are you doing to make sure that that data is correct? And then what sign-off have you got on the tax code? Client data not being updated in case of changes on circumstances. So we've seen this particularly on legal matters where an engagement has started with one client, but then quickly moves on to another. The VAT determination hasn't been updated as a result. Invoices being addressed to the payer of an invoice rather than the recipient. So again, this is a common issue. When you're looking at VAT determination, you need to focus on who the recipient of the service is, to understand who the supply is made to, not just who's paying for it. And there is a key difference between that, because you could very well pay for a service but not be the recipient. The use of care of addresses from overseas, again, you need to understand who your recipient is and understand what the VAT liability is meant to be, not just who the invoice has been addressed to. So for example, a shared service center overseas. And then transactions in regards to UK land and property, again, a common one for professional services industry, and can be a complex issue to really deal with. In some situations, it's been treated as taking place outside the UK, when actually it's a land-related supply, and therefore should be treated as within the scope of UK VAT. So again, HMRC focusing on a number of corrections that have gone in, but also the safeguards. And again, depending on the responses that you've received from HMRC in regards to the thematic review, do you need a more controlled environment? What steps have you taken in place? And actually, then how does that compare to the guidelines for compliance as well? Okay, next slide. Now, moving on, another piece that I wanted to bring up was bad debt relief. So there isn't necessarily a particular update to discuss, but it is more of an issue that I've been seeing more and more often in the last year. So just as a brief summary, bad debt relief allows businesses to claim output tax that's been paid on supplies where payment hasn't been received. Now, there are a number of conditions for that. So, for example, the amounts have to be written off in a bad debt relief account, which we'll get onto shortly. The value of the supply must not be more than the customary value. The debt can't have been assigned, sold, or factored. And the debt has to have been unpaid for a period of 6 months from the due date. Now, if you meet those conditions, then you should be able to claim bad debt relief and reduce the amount of output tax that you've paid. What we've been seeing in the professional services industry is that there are specific rules around the allocation of payments. So, for example, there may be a number of invoices outstanding. Now, under VAT rules, if you receive partial payment for those invoices, you have to attribute that payment to the oldest invoices first and then move forward. However, what we've seen in some instances of ERP systems is that the ERP system will attribute the payments to third-party costs first, because those are real costs faced by the business, and then they'll attribute it to the actual WIP for the professional services firm. So to take an example of a law firm where they, or a consultancy where they seek support from an overseas subsidiary, that overseas subsidiary bills the UK firm, and that invoice is held on account for a certain client account. If they receive part payment for that, we've seen the ERP system attribute the full payment to the third party cost before it's actually attributed to your actual your own time more than anything else. Now, that doesn't necessarily stack up with HMRC's rules on allocation of payment, and that can sometimes lead to an over recovery of bad debt relief. So we wanted to obviously bring this up again just to make sure that businesses are comfortable that they are compliant with all the rules and compliant with the allocation process as well. Next slide, please. And the other conditions that you need to be thinking about, and as I already mentioned, is the bad debt relief account. So it's not a specific account that you need to maintain in the ERP system. Even the spreadsheet would suffice, but you do need to maintain a bad debt relief account. And that needs to show the amount that you've written off as a bad debt, the VAT that you wish to claim for bad debt relief, the VAT period in which you've claimed a refund, the total amount of VAT charged, and then the VAT period in which you've accounted for the VAT originally. And if there's been any payment received, when that's been received, the name of your customer, the date and number of the invoice in which the bad debt relates to, and effectively this all needs to be maintained on a single account. And it's really important that you maintain this, because we've seen case law where HMRC has challenged businesses, even where they've been able to argue that they have this data in their ERP system, it's just not maintained in the bad debt relief account. HMRC has challenged them and in the courts have actually won, because these requirements are actually set out in law, and they've been able to then claim back VAT that this business has originally claimed as bad debt relief. So,
and this just highlights again, doesn't how important controls and compliance are. It's a theme at the start of the session. Certainly, it carries through. So a lot of it is documentation, compliance,
yeah.
controls, isn't it?
Yeah, exactly that. And you're right. Like I mentioned at the outset, a few years ago, we were getting HMRC's opinions on VAT technical matters. The VAT liability of a certain supply, the ability to recover VAT on a certain cost, and HMRC's technical view on that based on the law. We're now seeing this move much more into controls and processes, being able to show you're doing the right thing, being able to show that you're mitigating risk. And HMRC now getting much more involved in that whole arrangement as well. But like with regards to bad debt relief, I guess the key is you could have controls and processes, maybe thought from a commercial perspective, but not necessarily thought from a VAT perspective. And sometimes you need to make sure that actually they meet both. And that's where we've seen, for example, this issue arise. So yeah, like I say, there's been case law on this in terms of maintaining a bad debt relief account. So it's really essential that you make sure you maintain this if you are claiming bad debt relief. Right. Next slide, please. So moving on, so again, picking up on the theme around the management of VAT. Some of you may have heard about the EU's VAT in the Digital Age agenda. So they, last year announced changes to the way in which they wanted to manage VAT in the EU, and that had three key pillars. So that was changes to the rules around platform economy, which shouldn't be particularly relevant to professional services firms. A single VAT registration, in which we have certain simplifications for that already around the one-stop shop. But going forward, there will be increased use of a single VAT registration to mitigate overseas VAT compliance, particularly when you're dealing with intra-community movements of your own goods and so on. So again, probably not immediately too relevant to professional services firms. Now, the key development, I think, will be for digital reporting and e-invoicing for intra-EU trade. Now, Originally, the development was meant to be a single regime, really, of digital reporting and e-invoicing for across the EU, but a number, and as I'm sure a number of firms have already dealt with overseas, there have already been a number of digital reporting and e-invoicing requirements introduced, and so there are a number of domestic regimes that businesses are trying to comply with already, and so there was quite a lot of pushback around a universal digital reporting and e-invoicing regime, given that the amount of investment put in by various countries in the EU in their own domestic regimes. Now, what are the key developments? So from July 2030, they're going to be introducing digital reporting requirements for intra-EU trade. That effectively is going to get rid of your EC sales list requirements. Now, some of the changes from the initial requirements were that there were going to be reporting deadlines from 2 working days from the invoice date. That's been pushed back to 10 days. There is now also a requirement to include bank details so that payments and flows can be tracked as well as supplies. For the July 2030, domestic regimes will stay in place. And then at the same time, obviously, invoicing is going to come into place. Now, EU member states with domestic e-invoicing reporting regimes will be required to harmonize their reporting regimes with the VEDA standard by 2035. Now, that was obviously originally 2027. So there's been a pushback, quite a significant pushback in regards to that. Now, a lot of businesses will probably be thinking about what that means in terms of their own reporting across the EU. Well, obviously, if you have a pan-European network, the key thing is thinking about what compliance you're going to need to maintain, what reporting obligations you're going to have, and how are you maintaining e-invoicing and digital reporting at the moment? How are you then going to overlay these additional requirements? And then, obviously, in the future, how are you going to try to align the VEDA requirements to what you're doing domestically? Now, interestingly as well, what we've seen in the UK is that HMRC have announced that they're going to be implementing, or they're going to be consulting on the implementation of e-invoicing, I should say. That consultation is expected early 2025. So again, if you had any sort of feedback on the implementation of e-invoicing from other EU member states or overseas, it may be worth thinking about adding to that consultation to flag the issues that you've potentially dealt with. Yeah. Next slide, please. Now, moving on to the case law update. So there's, again, you'll see that there's a number of themes here, primarily around the issue of establishment. So the most recent case that I wanted to bring up was the case of Barclays Corporate Services. Now, this is an important first-tier tribunal decision that looks at the concept of fixed establishment in the UK and VAT grouping. Now, just to clarify, for VAT purposes, there is a different test when it comes to working out if someone has an establishment in the UK or in the EU, because obviously we're still aligned in terms of those rules. From a direct tax perspective, you have the concept of permanent establishment. From a VAT perspective, we have 2 different concepts. So we have the business establishment and fixed establishment. The fixed establishment being having the appropriate permanent human and technical resources in a country to be able to receive or make supplies or services is broadly the definition. Now, in this case, it's important because in order to apply for a VAT group in the UK, if you are not incorporated here and you don't have a business establishment here, you need to have a fixed establishment. And in that situation, the entire company is part of the UK VAT group, not just the branch. Now, in this case, BSL was a UK company that was a representative member of a VAT group for Barclays in the UK. And Barclays Corporate Services was a US company that wanted to basically set up a UK branch to provide services to the VAT group and to some of the to BSL and to other members of the VAT group. Now, some of those services were going to be standard rated. And because Barclays was a partially exempt bank, there was a large degree of lost VAT if VAT was applicable on those charges. Now, BSC established a UK registered branch in July 2017, which was BSC UK. And on the 1st of December 2017, submitted an application to join the VAT group with effect from that day. Now, the new head of Barclays Services, Corporate Services UK, along with other managers reporting to her, were recruited from other parts of the Barclays Group. And most of the employment start dates were stated to be no later than the 1st of December 2017, albeit contracts were effectively signed at a later date. Now, HMRC, upon review of this application, rejected it. And they argued two things. One, they said that BCS was not established in the UK for VAT purposes. And even if they were established in the UK, that HMRC had the authority to reject the application on the basis of protection of the revenue, because they had seen internal documentation that has suggested that Barclays were aware that the VAT saving available to them could have been 15 to 20 million pounds. Next slide, please. So what did the tribunal decide? Well, the tribunal first decided that actually the protection of the revenue arguments weren't relevant, because actually in applying for the VAT group and in determining the VAT savings available to them, those weren't those did not go beyond the mere consequences of applying for a VAT group and being part of a single VAT registrable person. So effectively, the savings and the efficiencies available to you was just as part of normal consequence of applying for a VAT group. So that in itself wasn't enough to suggest that the protection of the revenue powers should be invoked. So the tribunal then therefore considered, well, is there enough of an establishment here to justify VAT grouping from the 1st of December? And from that, they also said no. And that's for a number of practical reasons that we've listed below. So, excuse me. Of the employees, 3 of the 4 employees were working full-time in other parts of the group on the 1st of December 2017. And so they weren't exclusively working for the branch. As I mentioned before, the employment contracts were backdated. So they weren't really, whilst they were effective on the 1st of December and said their employment was no later than the 1st of December, they weren't effectively signed by that date. Also, the agreement to use office space was not set by the 1st of December, so that hadn't been agreed either. And there were emails suggesting that actual key decisions that were taking place in meetings were without the involvement of the branch's key leads. And actually, there was one case in which the head of the branch had asked for a meeting to go ahead on a certain matter, only to find out that not only had the meeting already occurred, that all the decisions had been made already. And then, as I mentioned as well, staff were still working on a range of other matters. So the tribunal held that from the 1st of December, the branch didn't have enough resources to be considered to be a fixed establishment in the UK, and therefore the appeal was rejected. Now, Barclays tried to argue or tried to ask the tribunal to opine on when appropriate resources were in place, because obviously that was just looking at one point in time, and the tribunal refused to opine on that, saying, well, they were only required to opine on whether there were sufficient human technical resources from the 1st of December, not at any other point. So what's the implications? It really kind of highlights the importance of ensuring you get these kind of things right. Obviously, it's important to note it's just a first-tier tribunal, so it's not binding on any other party, but it is very persuasive in terms of understanding where the line is drawn in terms of human and technical resources, and again, making sure that you have those resources available to you if you are setting up a fixed establishment. Next slide, please. So the next case that we wanted to bring up was Visual Investments International, which was looking at the reclaiming input tax on legal fees. And again, it's a useful reminder really on the position to think about here, and where you have a direct and immediate link to suppliers. So in this case, VI held a 51% stake in Broadcasting Investment Group, or BIG. It tried to enforce a verbal agreement for the transfer of shares into companies in which BIG was meant to be the purchaser. A settlement was eventually reached, And throughout that time, BIG made no taxable supplies. Now, Visual Investments tried to reclaim the VAT on the legal fees they incurred, and they argued that there was a direct and immediate link to their intended business, which was management consultancy for the subsidiaries. But that was never realized because obviously of the issues that were dealt with in terms of the legal issues that they were facing. However, HMRC argued that VAT wasn't recoverable because BIG was more closely connected to the supply. And I think they did concede in some instances. They're saying in some instances where the invoice was addressed care of Visual Investments, that they could be potentially seen as partly the recipient of some supplies, but not for everything. Now, the tribunal considered what was the purpose of the original lawsuit, which was really to force the transfer of shares to BIG to sell, for them to be able to sell for the higher price. And that VI may have intended to provide management consultancy, but this wasn't the purpose of that lawsuit. So from their perspective, they're saying, could there be really a direct and immediate link to the provision of management consultancy? And they held no, because actually the legal costs were incurred to protect investments, not to provide management consultancy service, or to ensure that you could provide management consultancy services. So there was no direct immediate link to VI services, and therefore there was no VAT recovery allowed. Now, even if there was a direct and immediate link, the tribunal held that only a proportion of the VAT would be allowed as recoverable because there were multiple recipients, whether that be BIG, whether that be the shareholders themselves. Now, that in itself was interesting because you can often be in a situation, particularly in a deal fee scenario, where you have a tripartite agreement and you might have multiple parties to a contract, but you might have a single invoice that you pay for on the basis that you've received all the supplies relevant in that contract, and therefore you want to recover all the VAT. This tribunal decision may suggest that if there are multiple parties, that you're only allowed a proportion of the VAT recovery. Now, it's only just a first-tier tribunal, but again, worth thinking about, particularly if you have any sort of transaction costs, you have any sort of investment arrangement that you might be involved in, you might be maybe looking to purchase another business. It's worth thinking about your VAT recovery and the costs that you're incurring. Can you establish a direct immediate link? Can you establish that you're the recipient and that you're the entire recipient? Or is there an apportionment that you may need to be thinking about? Next slide, please. So the next case is actually a CJU decision around fixed establishment. And it's one that keeps coming up. And so it's one that I wanted to clarify again, because I know a number of different professional services firms do use branch structures and may have branches overseas. So this related to a Romanian referral in regards to toll manufacturing services. In this situation, Adient Germany effectively contracted Adient Romania for toll manufacturing services. So effectively, they were contracted to produce certain goods using raw materials owned by Adient Germany. The Romanian company didn't charge VAT because they treated it as outside the scope on the basis that the general place supply rule applied, and therefore the reverse charge applied in Germany. The Romanian tax authorities, however, disagreed, and they tried to argue that the Romanian subsidiary and the resources of the Romanian subsidiary effectively constituted a fixed establishment of Adient Germany. So what do we mean by that? Well, as we mentioned on the Barclays case, fixed establishment talks about having the necessary human and technical resources to be able to enter into or make supplies or services. And so they argued that the subsidiary's resources constituted a fixed establishment of the German company. Now, even if they are separately legally distinct, cases like Wellery has suggested that if you have control over resources, then even if they are third-party resources, that could still be enough to trigger a fixed establishment. However, the CJU was pretty clear in their response and delivered two key lines. First is that being part of a group and being bound to a contract of service does not in itself trigger a fixed establishment. And more importantly, that you can't have a fixed establishment if the human and technical resources that are used to receive the supply are effectively the same resources that are used to make the supply. So in this case, it would have been a circular argument that Romania was trying to make, in the sense of saying that it was both that the toll manufacturing services were both made and received by the same resources, which is a nonsensical result. Now, A number of cases come up on this before, like Cabo Plastics and otherwise. So it could still be an area that keeps getting raised at the European level. But again, it's important to understand the concept of fixed establishment and where you may have one, even if you're using third-party resources or not, because you need to then think about what that means for VAT purposes. And as I mentioned, you may have a position around the permanent establishment and an allocation of profit based on that. But when it comes to fixed establishment and determining VAT, that can be quite complex, because then you're looking at invoices and which invoice should be addressed from which establishment, which purchase invoice is seen as received by which establishment. And there can be quite a lot of complexity around that. So understanding your fixed establishment position and your VAT registration position is going to be key. Next slide, please. And then finally, we wanted to raise the Hotel Latour decision. So this has been ongoing for some time as well. As you may have recalled from other updates, this was looking at a situation where a hotel business was looking to sell a subsidiary in order to finance the building of another hotel. Now, in their view, because they had documented evidence in regards to this, their view was that they were able to recover all the VAT incurred on the deal to sell their subsidiary, because there is a direct and immediate link to taxable supplies, i.e. the building and sale of a hotel and provision of a hotel, rather than a sale of shares, which would be VAT exempt. Now, Hotel Latour won both at the first tier tribunal and the upper tribunal. However, at the Court of Appeal, they've lost. So the Court of Appeal said that the upper tribunal failed to apply the direct and immediate link test, which we've covered already, and incorrectly disregarded the sale of shares. And quite fundamentally, that the costs were used and had a direct immediate link to a VAT exempt sale of shares, and therefore they weren't entitled to VAT recovery. So obviously they've lost at the moment, but we understand that they have taken this to the Supreme Court. And so we're expecting obviously their decision on this matter later. But again, it's worth thinking about any situations where you have undertaken a share disposal that may have been VAT exempt. If that was for a wider business purpose that you can evidence, it might be worth reflecting on your VAT recovery and what steps you might want to take to protect your position. So whether that needs to be, for example, a claim or a kind of an appeal that stands behind this matter, again, is something that you probably should be considering. And with that, that is my update.
Thanks, certainly lots to think about and lots covered in that session, which has raised a few questions from the audience that got a bit of time just to run through at the end. So we talked about bad debt relief in one of your topics. So I don't know if you can comment on this, that for bad debt relief, if the account is properly maintained, does a specific provision in the accounting system against a specific debt, which therefore hits the P&L account count as being written off?
Sorry, can you say that again? So are we talking about the set off here?
Yes, that's right. So yeah, that's right, to set off.
Yeah. So yeah, I guess the bad debt relief account is the piece that's meant to really show what is being set off against what. And again, like I say, as long as it's based on a oldest invoice first, and it's not doing anything odd with the third party costs and allocating to those first, and then attributing the rest to your actual fee, then that should be fine. I guess the key is how comfortable are you that the set off allocation is kind of working correctly from a VAT perspective.
Yeah, understood. And then you've also discussed kind of the increasing number of HMRC inspections, and we've had a number of questions from our client base as a team around how firms can prepare for the inspections. Have you got any advice or tips on this?
Yeah, we haven't seen HMRC confirm exactly what they're looking for at the moment.
Right.
But from other inspections, what we know and what they continue to do is ask for all VAT records available to them, invoicing, VAT returns, etc. Now, some of the things that we've seen in the past, they've often asked for reconciliations. So reconciliations to your bank records to basically show, the inflow of funds, outflows, and how that then reconciles to what you're confirming on the VAT return as revenue or as costs. Yeah.
Yeah.
We've also seen them request a reconciliation to your annual accounts, because obviously HMRC will have access to your accounts through Companies House. They will most likely have pulled those accounts in preparation of the inspection. And so they will want to see, and they will compare those against your VAT return figures, your sales and your purchases. So they'll want to do a reconciliation of your VAT return to your annual accounts. So if you can prepare that in advance of an inspection, that would probably be time well spent as well. You would probably also want to do things like I mentioned, like compare yourself against the guidelines for compliance,
Right.
to make sure that you're comfortable, you have appropriate controls in place in case HMRC raise any questions, just because it is a recent development, and we've recently seen HMRC start to release in questions or letters about inspections. And then I think there is also a piece around sample checking. So a piece around checking high value invoices, purchase invoices, where you've recovered VAT. Yep.
Yeah.
How comfortable are you that you can recover the VAT in those instances? How comfortable are you that you received the VAT, you received a valid VAT invoice? And again, I keep bringing the legal industry up, but sometimes it's a common issue where council fees, they will issue a request for payment, which looks like a VAT invoice, but they will not issue a VAT invoice until they've received payment. So how are you ensuring that you're only recovering VAT on the corrected VAT invoice? And how do you ensure that how do you ensure that you've correctly accounted for VAT in the right period? So
And
it's
how many years can the inspection go back ish?
so realistically it'd go back 4 years, up to 4 years, because
Yeah,
that's the
standard
statutory
rule.
limitations for
Yeah.
error corrections for VAT. So you'd probably want to expect HMRC to be asking questions around that. The other aspect I'd say, and as it kind of came up with the thematic review around controls around your VAT determination, when you're not charging VAT on the supply, what evidence have you got to prove that? And how can you justify that to HMRC? So again, I think the steps that you can take around reviewing some of those invoices and now obviously can help preempt sort of questions that you might get from HMRC. Beyond that, it may also be things like your staff expenses, things that I would say are common areas of risk that HMRC will pick up on. So your staff expenses will be a common one. Do you have a VAT invoice? If the excuse me, if the invoice or if the receipt is for a cost more than £250, you need an invoice, not a receipt. So are you claiming VAT correctly? What controls do you have around business entertaining? Things like that is probably worth just verifying what you're doing around that, and maybe sample checking some expenses as well.
So would you say it'd be prudent, and I'm sure you're helping lots of firms having around a document around their VAT processing, if firms haven't really got that, having that in place, and I guess it varies firm to firm as to how comprehensive that might look.
Yeah, exactly. Like we would definitely recommend anyone to have a VAT return process document, just at the very least. It's good practice internally, depending on who is kind of preparing the VAT return. If they're not available, for example, for during a VAT return deadline, then who's going to be able to pick up that return and follow the process that you need to follow without making any sort of errors. So it's always a good thing to have, and it's always a good thing to show to HMRC, particularly if you can, as part of the control process or as part of the process, document where your controls are in that entire process. It's always a good thing to show to HMRC. I think the other point to mention, though, is we have seen in certain instances where HMRC have been asking for your tax risk matrices and your kind of internal documentation, which might go into a huge amount of detail, which I don't know if obviously if everyone has. That can sometimes be requested as well. There is a piece there around around the wording and kind of what you're documenting and what you're showing to HMRC, and sometimes pushing back really on what it is that they're requesting and providing like a summary version, just because obviously these are like internal documents. and not necessarily meant to be shown externally. But again, it's something that just should be thought about, that they can also request.
It's useful. Thank you. You touched on fixed establishments. What are some of the issues raised around fixed establishments?
Yeah. So, as I mentioned, I guess the first point is, do you even have a fixed establishment from a VAT perspective? And what does that mean from a VAT registration perspective? So do you need to register overseas? Do you need to register in the UK, depending on which way where the resources lie? That's one point. The key thing that I find is more practically, how do you manage VAT on a day-to-day basis? So to take that example, we've seen lots of situations where a UK consultancy firm obviously set up in the UK, but then has a branch in Germany. And both entities or both establishments can be involved in the supply. The question then is, well, which entity is meant to be reporting that supply from a VAT perspective? Do they report it in on their UK VAT return? Do they report it on their German VAT return? And post-Brexit, that becomes even more complex now, because previously the focus was on business establishment, and you would rely on the business establishment unless that created a nonsensical result or an irrational result under kind of EU case law. Now that could mean double taxation in the EU or non-taxation in the EU. So post-Brexit, if there's no taxation in the EU, does that lead to an irrational result? So it's things like this now that we are starting to see are presenting more of an issue around your VAT determination, your control and process around invoicing, around who's responsible for invoicing, who's responsible for receiving a supply, and who reports that on there, and which entity reports it on the VAT return. Those are practically the issues that we're starting to see. And yeah, it's something that keeps coming up.
Got lots of questions coming in, Ish. I'm afraid to say, so we'll try and cover one more before close. But from your perspective, what training can you offer law firms to ensure they're fully compliant?
Training. So there's a number of different trainings that are available. Obviously, we have the BDO store itself. So if there's some VAT training on there, if that's something that you want, you can also do something on which I prefer, which is face to face. Covers the key areas that you need to be thinking about. Now, you can tailor that in whichever way you need. I think the key though is really making sure that the right people with the right responsibilities in different areas, for example, AP, AR, have the right training that's relevant for them. So, for example, staff in the AP team are not going to be as interested in how you prepare your VAT return and the kind of the training you need in that area. Likewise, people who are responsible for raising sales invoices aren't going to be as interested in what AP do around processing purchase invoices. So I think the key is making sure that it is tailored and appropriate for what they are doing, and that they have the appropriate resources in place to be able to reflect on the training provided, so that they can also then make decisions after the training has been provided. And again, that's something that we can do. It's pretty bread and butter stuff.
And you can go sector specific, can't you? If the firm specifically wants legal sector, you can certainly highlight the key issues that you see in that sector, given your experience, for example.
Yeah, precisely. And we can, as part of that, also tailor it to that specific taxpayer. So the individual issues that they're dealing with, or the nature of their types of business, we can tailor it to them as well.
Perfect. Just conscious of timing, there are questions that we've not managed to come back on, so we'll look to reach out to you separately on those. But thank you very much for all your Q&As, for a nice interactive session at the end. So this does bring us to the end of the webinar. Thank you, Ish, for your presentation. Very interesting. Lots of points and things to take away and think about there. We'll circulate the slides and recording of this webinar in the next few days. And that brings us to the end of the 2024 Professional Services webinar series. So thank you very much for your attendance throughout the year. We'll shortly be updating our website with the 2025 series. As always, we look to improve, and we'd welcome any feedback on any topics that you potentially like covering in the coming year. So please do contact me directly if you've got anything you would like to see in the next year's series. Wishing you a lovely day ahead and a fantastic festive period. Thank you very much for your help and attendance today.